Grow your practice, grow your wealth, grow your impact. Find out how to spend less time in the dental chair and more time on the things you love.
Welcome to the Dental Wealth Podcast. Glad to have you back for another episode. We've gotten some great feedback from people who this podcast was their intro. You know, we've gotten a lot of feedback that this podcast was really their intro into true business ownership, right? That they started looking from a paradigm at a business in a different way, right? And we've had people say, look, until I listened to the Dental Wealth Podcast, I was looking at my business wrong. I was looking at it a different way. And so, you know, I appreciate the feedback. You know, keep it up, keep listening. You know, we always look at the numbers, and we're very blessed to have all you listen. What do we got on the tap this week, Matthew?
So there's been quite a few things going on in the business world. I think, one of the most popular things is this whole fiasco with Game Stop and Robinhood, and I want to talk about it. I feel like every single person's talking about it, but you never know what Eric's take's gonna be on the whole situation. So before we even dive into it, can you explain to the audience in basically layman's terms what's going on? Because I know a lot of people are kind of scratching their head. They're like, shorts and Robinhood did what? And there's GameStop involved. Now I think AMC's involved now. So, and you got a bunch of Elon Musk. Everybody's giving their own opinion. So I'm curious to find out what your opinion is and what actually it means.
All right, I'll unwrap that piece by piece. All right, so let's talk first about, I'm going to give it between us, I'm not going to sit here and explain what shorts are and puts, and I'm not going to get too far in that. But I do want to explain kind of what happened, which is ultimately speaking, GameStop is on the road to be Blockbuster, right? I mean, if you think about the model, it's antiquated. We talk about sigmoid curve when it comes to business and say that we have inception, we have growth, we have maturity, and we have decline. If you look at GameStop from a company standpoint, they're set up to go in decline. I mean, ultimately speaking, even 2 years ago, you had to go buy the new video game, the Call of Duty or whatever. You had to go to the store to go get it. And then you'd have to go to the store and, that's what, so people, we're going to GameStops. But what's happened in the last maybe 48 months, 24 months, however you want to look at it, is we've been moving away, because they've been started about probably 4 years ago. Really starting to move away from physical. Yeah, you
do digital download. Right. And all the new consoles are all digital download.
Right, and they were probably the last industry to still want this actual disc, right? And so what happened is a hedge fund. Now a hedge fund makes bets, and ultimately speaking, they were looking at the stock. And they were saying, we believe that this stock is going to go down. So they basically made a wager, and it's
betting that it would go down.
Betting that it would go down. And so some people saw and took notice of that. And when they did, they decided to buy, which ultimately speaking, drove the price up, because the increase in demand increases the price. And ultimately speaking, the hedge fund, which, by the way, some people will say, well, hedge funds are, why are we looking out for hedge funds? Before everyone beats up on hedge funds and understand, well, they're really wealthy and this and that, understand there's a lot of pension plans in those hedge funds. So we got to kind of keep that in mind. So they were making a very safe wager, I would say, the hedge fund was, that GameStop would go down. Well, this is an artificial movement of the market. GameStop's not worth the valuation, and it's going to come back down. But ultimately speaking, they try to short the market, is what they call it, and some people basically played a game because that's a bet. A short is a bet. So you're betting that the market's going to go down, and ultimately speaking, they artificially drove up the price. Now, how does Robinhood play into that? Robinhood, I got a long email from Robinhood, by the way, which is I was funny. I was like, how many lawyers sat in a room?
I remember a couple of years ago, you're like, you should look into Robinhood. And I've seen a lot of influencers are like, do Robinhood. I mean, one of the biggest companies out there right now that's really going after Robinhood is Barstool Sports, because they promoted Robinhood on their platform. And they have a bunch of young millennials that were basically the cause of this whole thing.
That's right.
People that were on Reddit, which is a blog channel, and it's probably the most popular blog channel in the entire world is Reddit. And they gang together and accomplish this.
Well, and so I have 12 financial investing apps, because I like to see what's happening, what the platforms are. I've got money with all of them, but it's kind of more of a curiosity a lot of the times than anything else, to see which platform I like better. And
well, and I thought when I do research for things to come up for the podcast, what are we going to talk about? I've seen a lot of articles lately that are saying the financial industry as a whole is kind of transitioning towards the automation piece, where it's like apps and individual investors, and they're finding loopholes that way. And it's
to give you like there was an app like. It's so interesting because, and this is where the financial industry took a long time. We're going to get to your dental practice, by the way, so just hang with me. We'll bring this back to dental. We'll wrap it around. So I remember I had an account with Betterment, which is a digital investing app, and then I have a brokerage account, TD Ameritrade. TD Ameritrade still wanted me to wire funds over, and it was like 2019 or 20. I remember this time going like, you want me to do what? And Betterment, I can hit a button and it would just transfer my account.
Yeah. And you liked Acorns too. You used Acorns for a little bit.
I like all those little. I try them all. Like I just try to see their platforms because I'm always interested in the market, right? I'm always interested in business and business platforms and what people are doing. I like to stay and keep my hands in what's going on. So I didn't really like Robinhood, to be honest with you. I'm not going to get into that why, but I still have Robinhood, and I have a lot of those other apps because I try to see them. And then some of the budgeting apps like Personal Capital and things like that I'll play with. And just, ultimately a lot of them are trying to sell you something, which is why I think that the Mint one, I tried that years ago, that's a mess. Like I stayed away from that.
Well, there's always like an upcharge too. Like you're in the basic level, but to get the advisor to give you feedback is this.
Well, I think their feed system, and I get it. Once your portfolio hits a certain point, then you're going to start getting phone calls. Trust me.
So GameStop, bunch of people went in, bought it. How does that affect Robinhood?
Okay.
Because that's a big topic of conversation.
Okay, so there's requirements. Ultimately speaking, you have to have so much cash on hand. There's a reserve requirement that brokerage firms have to ultimately hold. So you have to have so much cash. Because when people want to have, they don't have to hold, for instance, if there's a 100 billion, right? They don't have to have 100 billion out, but they might have to have 10 billion, right? So what ends up happening is they have the SEC ultimately requires, the federal government requires them to meet a reserve requirement. What they were saying was once they hit a certain point, now we could argue whether that is ethical, not ethical, but ultimately speaking, once they passed the threshold, they made an executive decision to say, we cannot... We have to protect the business. We have to protect their employees. We have to protect, ultimately, like we will be out of this requirement because this is artificial. This isn't reality. So they made an executive decision. Now, look, 6 months from now, no one's going to think about it. And anyhow, they'll move on. And ultimately speaking, they had to make a decision to protect the company. I'm not going to get into whether that was right decision or wrong decision. Ultimately speaking, they have a threshold. When they went over the threshold, they made an executive decision to shut down trading of that stock. Like I said, I'm not going to get into all of that, but it does get me into this conversation, bring it back down to dental practice. And so look at the volatility, right? We look at volatility in the markets. And I think it's really now what I thought was really cool about it was that this idea of marketplaces changing, influencers now having effect on financial markets, which is something to consider. Because now all of a sudden, for the first time ever, you had literally, by the way, Elon Musk sends one tweet about Signal. And look what happens. I worked with a congressman down south when I just got the military, and literally he was like 28 points up in the polls to be the governor of Florida. And ultimately speaking, the president made one tweet, and his competitors passed him in one day. Look, the social influence. Look, we understand there's Bitcoin. We understand there's movements in the markets. That we understand that there's social, literally a group of people getting together through social networks can now affect share price and inflate things. And we look at this and say, okay, and we also talk about the bubble, the looming bubble, right? We all know there's a looming bubble, and you can go back to this podcast and go, he said it. No, it's a looming bubble. So we start to see this. And then we also start saying, right now, the new administration is going to spend at a rate that is probably never been seen by any administration. And so now all of a sudden you have extremely rising deficits. You have, uncertainty in the marketplace, people influencing. Okay, what does this have to do with the down practice here? Okay, I hear you. I know what's going on. Okay, some people got together. They artificially inflated the price of a stock. It ultimately affected the hedge fund, which ultimately holds pensions. So there's a reason why the government got involved. Robinhood shut down because they felt it was in the best interest of the company and truly shareholders. And so they made decisions. What the heck does that have to do with the dental practice? I think that's probably the most important thing. Warren Buffett once said, diversification Diversification is a protection against ignorance. The diversification makes no sense if you know what you're doing. See, Warren Buffett's strategy was always to find great companies with great management. And what he did was he bought companies that he felt confident about the management because he felt like, I don't need to own everything in Berkshire Hathaway. Ultimately, what I need to do is find great companies with great leadership and great potential. And so he thought, well, why would I diversify? I bet you that if I looked at the management of a company and I looked at the right companies, goods that everyone needs, like insurance, right, and Geico, right, things like Coca-Cola, which are mainstays, right. We look at some Helzberg Diamonds, which is a jewelry store, but it has people are always going to be buying engagement rings. Like we look at some of the things he's bought, and we could go on and on and on. And his idea was, I'm going to find great companies that have the right bones to do this, and basically I'll buy that portfolio and I'll bet on that portfolio all day. It goes back to dental practice to go, look, there's so many people right now that are pitching you against this idea of investing in your dental practice. Yeah. They're pitching you need to be putting more money in the investment world. You need to put more money here, put more money there. Now, I'm not pushing you. I'm not going to tell you don't invest in the market. I do. I'm not saying that don't invest, don't have qualified funds. I'm not saying, look, maybe you do, maybe you don't. We talked about investing in your practice way before you put money in qualified funds. If no one knows what that means, by the way, that's like 401k IRAs. But why would you? It goes back to the same thing. See, I don't have to worry about the instability in my dental practice. In fact, if you look at dental practice over a 30-year track record, the only instability in my practice is what effect does private equity have on that? And we can talk about that in another episode. But ultimately speaking, I know the predictability of my dental practice. I know that people aren't going to get on Reddit and crash my business. I know that a predictable rate of return. I can know my acquisition cost. I can understand what the return is. See, this idea of, and people get hyped up right now, right? When high markets were like, buy Bitcoin, buy this, buy that. You'll make tons of money. Well, in 2006 and 2007, they were saying, buy real estate, buy real estate. Anybody, by the way, everybody was a builder and everyone's an agent. I lived in Sarasota, Florida in 2004 and 2005. And I remember saying more people had real estate licenses than driver's licenses.
Everybody.
Yeah, because everyone was like, make a fortune, right? It's like everybody was in real estate because it was overinflated, right? And then we started to look at it and goes, of course there's a bubble, right? Of course there is. And so the same thing's happening now, and it's happening through the financial markets, and it's happening with Bitcoin, it's happening with everything else. We start to see these overinflated numbers, and we say, well, it's going to fall eventually, especially if you watch the fact that our new government coming in is probably going to rise deficits to a crazy number. Now, you can talk about the influence of that in gold, and we could get into all these long conversations about the U.S. dollar and inflationary measures and all these other things, but ultimately speaking, I want you to let that go for a second and say, why are you spending so much time and energy on something you have little to no control over? You have this practice that's yielding you probably somewhere between 15 and 40%, depending on your structure. Why in the world are you taking a large sum of your money and putting it somewhere? I mean, I'm talking about, like, by the way, if you've invested fully in your business and you've maxed it out, great, that's fine. Then you can do it, or some of you are overwhelmed with debt. You got so much debt you can't even breathe sometimes, and hell, you're putting it into a market you don't even know. I know what my interest rate is, and I know how much stress it creates, and I know those types of things. And what ends up happening is someone says, well, I'll put it in the market because the market's going to do this. My interest rate on my house is only 3%. What if the market drops in the next 10 years? See, what financial advisors do is kind of convenient, and watch their models. So they'll say, since the Great Depression, the average return is 7.6%. You don't get to live in the whole, from the time of Great Depression to now. You only get to live in a subset of that. This subset, they use the law of large numbers to go, if you go back and go all the way back to 1920, look, I don't get to live and work from 1929. I don't get to do that. I actually, if you look at it, I get to, maybe it's from 2000 to 2032 or something. And so that's a unique period of time. And we don't know, by the way, the markets are moving and changing. And I think the culture of America, the landscape is changing, how we invest, AIs in cars. And look, I think that, can you put something like, look, I've got a client who bought Bitcoin very inexpensively. We don't know what will happen in a long time, but maybe he made a good bet. I call it home runs, right? I always say in business, you have bunts. I want you to write these down if you're listening. You have bunts, you have base hits, and you have home runs. And ultimately speaking, you should have all three.
Yeah.
Right? You should have some things in your bunt category. The things that never go down. The things that ultimately are always there. It's an accumulation. It's not sexy. You're not going to get a huge return, but you know it's always going to be there. We have home runs. Yeah, every now and then you swing for the fence. I remember in 2009, I bought a whole lot of Apple because I think it went down to like $71 a share, and I just home run the hell out of it and sold it for like $600 plus a share. Look, I mean, yes, you get some home runs, but that's not what I'm banking on.
Yeah.
What I'm banking on is what consistently will give me the consistent return. That's called my base hit. Yeah. Yes, in baseball, we would love to hit home runs every time we get up. Yeah. But what we're trying to get is base hits because we know with enough base hits, we'll ultimately win the game. The same thing happens with your dental practice. Your dental practice is your base hit. It's consistent. You know the return. You know it's predictable. You've got long years of predictability to know what's going to happen. So why in the world would you do everything in a home run category? Yeah. Don't push everything into a home run. No, you'll hit in a market like this. You're like, oh my gosh, I lost out because I didn't. Look, you don't know what's going to happen.
Yeah, you don't know.
I mean, you know, if you knew the markets, you wouldn't be listening to this podcast because you'd probably be on some exotic beach as a trillionaire, right? I mean, so nobody knows. But here's what I do know. I know that a dental practice is an amazing place to put money. I know that private equity is coming in droves. Why? Because they can purchase a practice doing $500,000-$600,000 and turn it into a practice doing $2 million overnight. Because ultimately speaking, it takes the average doctor 20 years to save $1 million, but yet we can derive $1 million valuation in 12 months. Yeah. We start to look at this as an asset and go, you can make a hell of a lot more if you learn how to invest in a dental practice than you can in the market. Even if you had a home run in the stock market, you still won't come close to what you can do with the valuation and return of a dental practice. And I know some of you are thinking about income. Don't look at it as an income. Look at it in the asset. How hard would it for me to take your practice from $1 million to $5 million? Well, I just took I literally made a $4 million move. And we started to say that would take you 80 years to do in a stock portfolio, even if you use the numbers that these since the Great Depression. Yeah. So why am I not maximizing my asset? Why are you betting on home runs? Why are you hoping you hit the Bitcoin? All of this stuff, maybe it'll work out, maybe it won't. And know what category you're in. Is this a bunt? Is this a base hit? Or is it a home run? I think ultimately speaking, I know what my base hit is. Yeah. And I think we should all go for some home runs, right? Everyone should shoot for some home runs.
I think that's why corporations are coming in. They know they're going to get the return on it. Like,
that's right.
Might as well.
So they might as well. And so what ends up happening is to say you have this asset now. You're not going to have it. Look, if you got to look at this and say, why would I not increase the valuation? Why would I not work to increase it? We just did a webinar. On valuation, understanding valuation, and we had a lot of people all over the country sign up for it. Hundreds. It was a great event. You look at this and say, ultimately speaking, I need to. It's not even like I want to. It's crucial that I learn to maximize the valuation of my practice. This isn't about phone language, and it's not about just simply some consultant coming in and give you some process for your AR. This is about understanding the valuation and how to increase the valuation of your dental practice to maximize your net worth. And if you don't know how to do that, private equity is going to come in, they'll buy it from you, and they'll do it.
Yeah. And I think I just thought about this, like if you look at it from a different way, if you know there's buyers out there, like this is probably the time in a dental practice, like that people are looking at your practice, probably have looked at it, have compared yours to another practice, and there's in the marketplace people are targeting your practice. Why wouldn't you spend and focus in on that? Because most of the time you don't know if someone's looking at your business. You have no idea. You have to go out into the marketplace and say, here, I'm looking at doing this, and you try to attract those buyers. Right now you have literally like a ocean full of buyers looking at your dental practice right now, and you're the chum in the water. Like, so how do we make it to where they don't either want to take a bite out of you because you're so big, or they're like, this is a no-brainer?
Well, and I think when we have this conversation, people assume I'm saying sell to private equity, and I'm not. It's not what I'm saying at all. By the way, I was just talking to a practice, one of our clients, and they're a very large practice, and we were talking about how to set up a structure, ultimately speaking, with the associates, and ultimately there's a lot of ways to do this. So don't just assume I'm saying to get this ready to sell to private equity. What I'm saying is set it up for a valuation, because remember, I've talked to you, if you listen to this podcast, I've told you why to keep it, by the way.
Yeah.
And what the cash flow looks like if you keep it versus selling. And if you don't know that, go back to listen to especially some of the earlier podcasts. But look, you got to understand that there is something here to say, look, I always need to maximize the valuation of my dental practice. And if I'm not doing that and I don't know how to do that, then I need to get a team involved to help me maximize the valuation. Because ultimately speaking, why are you putting so much money hoping the stock market goes up when you're sitting on an asset?
Yeah.
That if I looked at your stock portfolio and I said, can you double it in the next year? You'd probably say, not a chance, not a chance. I'd say, not without taking a lot of risk, right? You might open your portfolio and swing at some home runs and do it, but ultimately speaking, you're better off going to probably Vegas. You probably have better odds.
And you'd be in the 1 percentile of all America.
If you could just double your portfolio in a year, every hedge fund investment manager. I remember listening to Ray Dalio, and Ray Dalio was saying, even if. So I want you to hear this, by the way, if you're listening to this thinking, no, my guy's good. My guy over at Merrill Lynch, he's the best, Eric. You don't understand. Like, my guy's real good. Let me tell you what, Ray Dalio, who would blow by your guy at Merrill Lynch, okay? Yeah. One of the top hedge fund managers in the entire world, one of the top investment minds in the entire world, said, even if you had the best software in the entire world and you could analyze the statistical analysis of every single trade that's ever happened and the effect on the market, every combination of how one market affected the next market, and you laid it out, if you had histograms and you had every piece of data and you took 3,000 Ivy League people and you put them in a room and we did all of that combined and we put it in a room, you'd be lucky to have 50-50 odds, is what he said. Yeah. Look, if people could figure the damn thing out, they would have figured it out a long time ago. Look, the markets make changes. If Ray Dalio, with all his background, with the gigantic computers he has and all the people he has access to, can't beat the market to that degree. Now he'll say, well, I could probably get 6%, I could probably get 7%, but he's not going to tell you he's going to go get 100%. Why? He's one of the best guys in the world. By the way, your financial advisor is a prospector full-time, not an advisor, just so everyone knows. But ultimately speaking, like, my guy's the best guy. They're probably working hard, but best case scenario. Go back and read Principles by Ray Dalio. He'll talk all about this. So I think you got to understand this. I think those things are a lot of those things. Now, there's consistent portfolios. We can talk about that. Yeah. So, but Eric, I hear what you're saying, but you understand my portfolio. It's a custom portfolio. It's diversified, and I'm 60-40, and I've got 40% of fixed income. And look, here's the thing. I agree with all that. That's great. Good. Set up a portfolio that ultimately is correlated with the beta of the market. Some of you know what that means, and some of you don't. But ultimately speaking, here's the thing long term. Why would I take money out of an asset doing 30-40% and doing it something to hope to get 6 and 7 and pay a fee to do that? Yeah. Because there's a bunch of fees that are tacked onto that. That's why people don't make money, is fees and fears. I'm not against the stock market, just like everyone know that. I invest in the stock market. I'm not against it. I'm not against, I'm not a big fan of business owners utilizing qualified funds because you have a much better place to put it and you're locking away your money. But ultimately speaking, understand what you have to have a right mindset as an investor around that and go, look, I've got an asset doing 30%, and then my advisor, if your advisor says to you that you should diversify away from your business, it's because they don't know what to do with your business, and it's a way to sell you. Do not listen. Somebody who tells you that you have an asset, who doesn't know to say, what is your profitability on that business before you start taking money out? They say you should diversify away from your business. They do not know what they were talking about, because the greatest investor right now living basically said that is a protection against ignorance. Look, don't maximize this asset. Maximize this asset to its fullest. Once you've maximized this asset to its fullest, fine. Put the money where the hell you want to. Pay off debt. You can invest more. You can buy another practice. You can put in your stock fund. If you want to put in your 401k, it's fine. But maximize this business first. So we get caught up, and I think I'm glad you brought this topic up, because we get so emotionally charged about, we spend more time reading stories about freaking Reddit and Elon Musk tweeting than we do our own financials of our business. And that is a damn shame. It is. So my dental wealth advice for today,
on cue,
right, is to go back and look at your own business. Look at your own profitability. Look at your own margins. Your diamonds are in your backyard. Go mine the diamonds you have. If you want to throw some home runs out there, that's great. If you fully invest into your asset and you want to, now that you've maximized it for the annual year and you want to do something with what's left over, great. If you want to maximize it and then pay off some debt and accelerate it, look, I'm really good at getting things paid off, right? That's fine too, because there's a part of reducing debt that reduces stress in our lives. And so I think all of those things are true, but if you don't know if you're spending all your time trying to maximize your Bitcoin portfolio and you're not maximizing your dental portfolio, you're making a huge mistake. People, well, Eric, but Bitcoin might go up to $1 billion. Well, it might go down to $5 too. We don't ultimately know.
We don't know.
So why don't we go on what's tried and true and what we know to be consistent? But Eric, blockchain technology, look, why don't you study the technology that's in your dental software and find out what's there? Once you've maximized that, we can talk about blockchain. And so, look, get focused in. This is 2020. It's a year of opportunity.
2021.
2020. Did I say 2020?
We're still. Everyone's like, please don't say it's 2020.
It's 2021. How do you know what year it is anymore? Look, it's a year of opportunity. Get into it. Look, there's going to be a lot of opportunity this year. A lot of people are asleep at the wheel still. A lot of people are still crying about 2020. A lot of people would be out of business if it wasn't for PPP and the federal government bailing them out. Now's the time. Most of you are in a great cash position. You have the ability to maximize this asset. This is the time. If you're sitting on a large cash position, if your practice is doing well, if you've put yourself where it needs to be, then you need to learn how to increase the valuation and maximize this asset, and this is the year to do it. Guys, thanks for listening. We're always glad to have you. Look, we just had, I think, 4 or 5 doctors tell us that, one of the things they do every week is they listen to this podcast, they share it with each other, and they talk about it as a team, and they go back and go to work on what we tell you to do. So, look, take this podcast seriously. If you're going to spend the time listening to a podcast, then make use of it and do something with it, so that way it can impact your life, your finances, and your future. So, thanks for listening. Thanks for watching, and we'll see you next time.